What is non-business income? From the name itself, we can know that it is the sources of income that are generated from non-business activities. Most of the sources are for personal, not from a company transaction, hence the name non-business income. There is also a specific act for the taxation of non-business income. To give you a detailed look for what non-business income is, let's take a look at a few examples of them.
Best and most common way for young individuals to start investing is through what is known as a unit trust. Now, a unit trust can be described as a pool of money from a whole lot of different investors. A fund manager then invests this pool of money into different companies, commodities, and even other unit trusts. The whole unit trust then makes a return which is distributed to the individual investors. There are just over 1,000 unit trusts in South Africa. So how do you decide which ones to invest in? Now that has everything to do with your goal for the investment and the risk exposure you're willing to undertake. My recommendation would be to consult an independent financial advisor to advise you on the selection of the unit trust. The minimum investment for a unit trust is normally around about 500 Rand a month or a minimum lump sum investment of 5,000 Rand. And that right there is the basis of a unit trust.
An annuity is a financial product that is designed to pay out a steady amount of cash over time. Annuities are generally used as a retirement vehicle to ensure regular income in later years. At their core, annuities are a contract between you and a financial institution. When you buy an annuity, you agree to pay a lump sum up front or make a regular schedule of deposits to a financial institution, usually an insurance company. The company agrees to pay money out to you starting on a particular date and to continue making payments either for a fixed period like 20 years or until you or your spouse dies. These payments are called distributions. The money you pay in is invested by the annuity company and grows until the date when distributions are scheduled to begin. As the annuity holder, you are responsible for the taxes on the distribution, but generally only for the income earned on top of the original investment. The annuity contract sets the age at which payments will start, what the payment intervals will be, and many other details. There are different types of annuities, including fixed, variable, immediate, deferred, equity indexed, and more. Choosing an annuity depends on the income you want in retirement and the amount of risk you are willing to take. The goal of any annuity is to provide a stable, long-term source of income for the annuity holder.
We know that business income are taxed under Section 4A and B, but what about other sources of income? Well, those other sources of income are taxed under non-business income. Non-business income are identified under Section 4C, D and E of Income Tax Act 1967. Under Section 4C, there are dividends, interest, and discount. Under Section 4D, there are rent, royalties, and premium. Last but not least, under Section E, there are pensions and annuities. Dividends are amount of money distributed to the shareholders. They were taxable during the imputation system, but starting 2008, the single-tier system is implemented, making dividends to be tax-exempt. Dividend is not defined by the Act, but we can refer to the meaning which is established in the court case such as TBT versus DGIR. Interest is premium or consideration paid for use of money or property. Interest is taxable under Section 4C, but interest on deposit in financial institution and unit trusts are generally tax-exempt. Basis of assessment for individuals is calendar year, whereas for company is accounting year. Discount under the Act only covers for discounts derived from treasury bills, discounting of bills of exchange and promissory notes, where those discounts are taxable under Section 4C. Basis of assessment is the same as interest, which is calendar year for individual and accounting year for a company. Rent is the sum received for occupation of premise or hiring of asset. Under Section 4D, the rent taxable is only for investment activity. If the property is owned and rented by a company, it is taxable under Section 4A. Example of the case is GDPD Factories Sdn Bhd versus KPHDN. For royalties, it is taxable under Section 4D. The basis of assessment for individual is calendar year, whereas basis for a company is accounting year. premium is a one-time payment made by lessee to the lessor to enter into a lease agreement. It is taxable under Section 4D, and the basis of assessment is the same as royalties. Pensions can be defined as payments made to retired individual. The basis of assessment for pensions is according to the calendar year basis. Generally, pension is taxable under Section 4E, but not all pensions are taxable. Some pensions are exempted from tax, which is explained under Para 30, Schedule 6. Annuities is a sum of money payable on regular basis, whether perpetually or a fixed term. Annuities are taxable under Section 4E, but under Para 36, Schedule 6, Malaysian life insurers are exempted from tax. Before 2012, income from annuity funds is taxed at 8%, but after that, income from annuity scheme fund is tax exempt.
Created using Powtoon.